Okay, hello and welcome back to season 2 of the Technical Bootcamp. Today in episode 4, we are talking about structure shifts versus liquidity sweeps. So sometimes the market will do what looks like a break of structure, but then actually flip and reverse on you, leading you to a losing trade. Well, this is the exact situation we're talking about today, and I'm going to show you the difference between shifts and sweeps, how you can differentiate the two before, of course, they burn you, and how you can actually trade those sweeps or failed shifts successfully. So even when the market doesn't go the way you want it to, it opens new opportunity. So with that said, let's get into today's class. Generally, a market structure shift is determined by a market that is trading in higher highs and higher lows, breaking down into a lower low. This is most of the time going to be indication of a reversal. When the market makes this new lower low, the expectation is that it will return on a corrective movement to print a lower high and then continue downwards, starting the new downtrend. Okay, so that's why we call it a reversal, because this point here indicates the shift from an uptrend into a downtrend. It's where the market has reversed from higher highs and higher lows into lower lows and lower highs, and this creates a selling scenario. However, not every single break that we see in a market is actually going to indicate a reversal. So sometimes we will see what on the surface looks like a break of structure, but doesn't lead through to a reversal. In fact, what happens in these cases instead is the market finds its footing again and runs to a new high. Now, you've probably been caught on the wrong side of these movements at least once in your trading journey, and maybe it happens quite often. Well, after today's video, we're going to be able to significantly cut down how often that happens. So the focus of today is differentiating these structure shifts from sweeps of liquidity. So the first example we're going to look at in this video is USD JPY. As we can see, this chart has some bullish structure behind it. So we are trading currently in an uptrend. We would anticipate, providing we stay above this low, that the market will remain bullish. And if we break under that low, then the market may reverse, right? Because what we would be seeing from there would be that break into a lower low, and then the anticipation would generally be a pullback to a lower high and then a continuation into a new downtrend. So we look to buy above this level and sell below this level, okay? That is generally how this is traded. However, this situation is a little bit different. This is actually one of those situations where we can, with context, determine whether this is a viable break or not. So if this structural low was to break, it would trade into an imbalanced range and it would push beneath these relative equal lows, the liquidity that we've got over here. It would drive into an imbalance and it would potentially lead towards a demand zone as well. So there's a lot of things down here that will be acting as magnets for price. We've got a demand zone that's untested and imbalanced. We've got liquidity, which is obviously going to act as a magnet for price. And then the other contextual thing we can consider here is, if we take a look at the range we're currently in, this is what we classify as an efficient range. There's no clear demand zone in here for price to react from at this point. So even if we do stay bullish on this market, there really just isn't a lot of reason for that to take place from where we are. And it might be that the market needs to collect more orders from a more significant area before we start to see buying commence. So because we don't have a clear demand, because we have equal low liquidity, because we have imbalance, and because we have a demand zone beneath, we could say that buying from here is not the best idea. If we want to buy, we would need to see it come down through this liquidity first and then find reversals from there, once liquidity has been taken and new volume can step in, or from the demand, once that has been hit and the imbalance is completely filled, right? Simply because there is no core reason for us to buy from here. So even though the structure is bullish, it may just need a bit more fuel to move higher. So we always want to think about essentially that fuel in the market, right? Now, fuel for movements comes from liquidity, comes from orders, comes from transactions. Let's talk about the liquidity around these regions for a moment. With these equal lows that we have over here, we know there are going to be a lot of selling orders beneath that level, right? So there's buyers here, there's buyers here, there's buyers anywhere in this range. And if they have a stop loss, it's generally, at least a significant amount, going to be situated underneath the equal low liquidity. So these stop losses are sell orders. If you buy, your stop loss is an obligation to sell those contracts back at a loss. So there's sell orders there in that case. And then there's also going to be sell stop traders who are looking to capitalize on if the market pushes under these, they will be automatically triggered into a sell to take the market lower. So these are support and resistance traders. Now with that motion in mind, we know there's going to be a lot of sell orders here. Okay. If we then take a look at the current existing movement, basically anyone who's bought over this low, a significant portion of them are going to have their stop losses beneath that low. Again, creating a big pool of stop losses and sell stop orders inside there. So if we were to average that out to the broader range, taking a look at this bigger picture, this whole area here is basically just a big collection of sell orders at the same price levels. Okay. Now, if we think about what happens if those levels are to be hit, well, that is what creates fuel for the market. So two things can happen when we hit this liquidity. One, we can see sell pressure injection, which could create massive downside. So we could see a huge drive to the downside very quickly. Number two, what we could see instead is absorption of sells into massive buying moves. So if we get significant selling pressure pushed into a market and it is not absorbed, what that does is basically create massive amounts of supply, which will sink a market dramatically. But if we see those orders being absorbed, what that simply means is when we get down to that point, buyers step in and kind of take control of this market, because what happens is at these levels, there is so much selling taking place that if you want to add a 10, 50, $100 million position into this market on the US dollar, well, now you've got a lot of liquidity at one point, a lot of sellers who are forcing their ways out of the markets, and you can take the other side of their trades, which is where the absorption comes in. You absorb all of the selling orders, and from this point of massive liquidity, we then see a market reversal as large institutional participants like commercial banks step in and basically eat up all the sell orders, replacing them with huge buys. So if we consider that we have a bullish bias in this market, we want it to go up, we see the uptrend is in motion, but we see that there is no significant buying demand from where price currently is in this region, well, then it makes significant sense that when the market trades into an area with lots of fuel, right, these sell order liquidity pockets, that we could see that fuel provide the opportunity for significant buys. Okay, so what we may anticipate here instead, given the liquidity that we've just discussed, and the fact that we don't have a clear buying zone from where we are, yet we are still structurally looking pretty strong, we could look for this, trading under this level, and then from there, taking the market higher. And now this reaction could happen immediately upon touching into the liquidity. So we don't have to fill the imbalance or hit the demand in this case, but it could happen from a complete fill of the imbalance and a retest of the demand. All this would do is basically absorb those selling orders slower, but reach into a discounted price range where we may have additional buyers just looking to step in here naturally. So it depends on how hard the absorption is on the buy side when we get down there. Okay. So in this case, what we would be looking for is a sweep and then a reversal to the upside, as opposed to the standard pattern we expect to see, which would be a breakdown and a reversal into downside price action. And the way that we differentiate between that sweep or that reversal, and the way that we can decide that this, even if the low is taken, should be a buying opportunity, is simply what's going on down here. Now, if we were to break through into a large, open, overextended bullish movement, and it was significantly imbalanced, there wasn't any clear liquidity there, and there was a clear demand beneath, and the break was very strong, then yeah, we could look at the sell side. But in this case, we've got a very small range, right? We just literally have the area from here to here, and there is so much intent inside of this area, and so much transaction interest, essentially, in terms of the amount of selling liquidity there is in here. And of course, the amount of fuel there will be for buying in here. And the significance of no clear demand here. Well, this becomes then a significant situation where the most probable outcome is not a reversal to the downside, but a sweep and collection of that fuel to then release more orders into the market on the buy side. So we're going to keep that in mind for a moment. But what I want you to do for now is just take a look at this smaller bit of price action. So what we're going to do is just zoom in for now on price around here. Now, as you can see, we have something very similar taking place, but on a smaller perspective. So we account for the fact that this is not a significant demand. There is no clear imbalance. The market's already pushed under this low, so we're trading in an efficient range. Now that immediately makes this range not great for reversals and something that is more likely to be taken out on the downside rather than creating a reaction for buys. Well, if we then zoom in on the price action here, we can see that we kind of have our own little trend inside of the trend. So we have a lower low, a lower high, a lower low, and then we've created a range. So you could say, if we isolated this situation, given that we have this lower low, lower high structure, this would be our valid lower high. If the market was able to break over there, that could lead us into buying opportunity because this would indicate a change in this smaller trend, right? But again, when we factor in the larger context, we run into the same situation. Now, above this high, because there's no imbalances left inside of the existing range beneath the high we marked, any selling that has taken place has liquidity above this high. So there are stop losses and there are buy stop orders. Think about what a stop loss is for a short seller. It is an obligation to buy back the contract. So every stop loss here is a buy order and every buy stop is also a buy order. So now we have the opposite. We got a lot of buy liquidity in here. Factor in the market context. This is not coming from a meaningful area. And we've got all of these magnet price areas down here that will draw price in. Well, then I would see this totally opposite to what the majority of people see. I would not see a break above this high as a bullish opportunity for us to buy into. I would see a break above this high as a lead in for some fuel to fuel the movement down towards the magnet price areas below. So this side, what people see as a bullish reversal, I see as a liquidity sweep to fill the range, get enough power to make the movement down. And then on the downside, what a lot of people will see as a bearish reversal, I see as an opportunity for the market to collect more fuel this way, trade into a more meaningful buying area, and then fuel the next movement up. So what we've actually got is what some people will classify as a reversal, which I see as a sweep. And again, the same thing, but on a bigger picture perspective, right? So we're differentiating here between reversals and sweeps by considering the contextual liquidity and orders and everything else that's situated around the areas we're in. And the most simplistic way to get that point across to you is just to keep referring to that point of market fuel, okay? Every movement, every significant movement needs transactions, it needs volume, it needs fuel. If we're in an efficient range, there's no core supply zones, there's no clear area, there's no massive seller or buyer intent from here, then we need to reach into an area where mass amounts of orders will be triggered at the same point to create liquidity or fuel for the next movement. And that is all we're looking at here. Fuel down here, fuel up there, nothing in the middle. So even if we want to buy, we need to wait for the low to be taken to create buying fuel. And even if we saw a break above here, that wouldn't interest me for buys because we're looking at seeing absorption of these buy orders, massive selling down to get to where the fuel is for a significant move higher, okay? And we factor that in again by weak buying zone, liquidity, imbalances, fuel down here, fuel up here, nothing in the middle, right? So if we take a look at how this market then went and played out, we got a push over this high, we reversed, we came back down, and then we had a selling opportunity. Now in real time when I was trading this, and this is a while ago now, about 6 months or maybe longer by the time I released the video, the selling movement was a movement like this. So selling from the high to bring down to the low. Now we closed this at the range liquidity low, which is just there. This is actually where we have the same kind of thing playing in motion again. So just down here, of course, we know there's going to be some fuel, some liquidity for the other way, right? This is kind of a smaller picture view of what we see on the big picture. So we have buying stop losses and we have sell stop orders creating sell liquidity in here. However, the sell liquidity that we have here is only factoring a small range. It's not factoring the more considerable larger trend. So the liquidity in this region is going to be a lot smaller than the liquidity on the big picture. This liquidity would not be enough to rocket price up to new highs, but it could potentially be enough to flip the market in the short term. So we could even see the market coming to this range liquidity and then maybe going over here as well. Now you may have seen these ranges before, kind of expansion ranges where we end up consolidating, but we continually make opposing highs and lows. So we'll make a higher high, but then a lower low, then a higher high, then a lower low. That's generally what is happening here. We're expanding in a range, right? Now, if we run this, you'll see that's actually what we did. We traded under this low, taking out that range liquidity. Again, what looks like a reversal in the moment, but isn't quite yet because there is still liquidity above and below. So again, you see we trade up, and then when we take out this high again, we are sweeping liquidity once again for, I guess, people like me who took this trade but didn't get out because I got out at the range liquidity low. If I'd have continued down, it's me, this kind of position, that would have been getting liquidated to create the fuel for the next movement. And the market ran like this for a bit, okay? So you can't really trust every break here. Now in this context, it's easy to determine what's a liquidity sweep versus what's a reversal because we are expanding, sweeping highs, sweeping lows, trying to collect enough fuel to actually get down to a significant point, all right? So it's a little bit of a trickier range to trade. You can trade from the range liquidity at the low to the high and so on. But realistically, we just want to ignore directional confirmation from this kind of range until we've made a clear run to where the fuel is, okay? But this just follows the same flow. Here, we went for fuel and we came back down. We got some more fuel, we went back up, we came for some more fuel. That's all we're doing, right? We're trying to fuel the movements to a more significant point. Now, this can happen endlessly realistically until we actually get down under this structural low. It's when we get under this point that will create the significance and the liquidity for us to actually get the larger movements, all right? So this is the real core point that we want to see the market get to, but there's nothing really stopping the market from chopping side to side until that happens. Now, here's the point where we've taken out the low. So here's what we could indicate initially as the point that would create a reversal confirmation and lead us into shorting the market. But because we built that idea around fuel and what we're looking for the market to do, and because we still maintain that bullish bias of these continual higher highs and higher lows that we see, this was kind of a sub opportunity, but the big trading opportunity as we prepped back here was to see this liquidity taken and then a bullish increase in price. Because at this point, we will have ran into a point, knocked off enough orders essentially, absorbed the other side of those and seen a massive rally in the market. Now this is indicated even by the wick, right? Take a look at the size of this wick. This is a wick rejection. This is around 70 pips in a wick, right? That's a lot of pips to be moving like that. Now a 70 pip rejection within the span of 4 hours is significant. And the reason that we saw such a rejection is because as soon as sellers brought the market down into this point, all of that liquidity was absorbed. The other side of the position was taken in force, and that drove a 70 pip wick reversal and around another 50 to 60 pip candle as a bullish closure. Now, if we see what happens from this point onwards, we actually go and take out the highs entirely, creating a very nice bullish movement for UJ. And this actually fueled then the next movement up. So what we did here was use the context, the buying areas, the liquidity, and the understanding of where the fuel in the market is to avoid buying above this low, and also to avoid treating this as a reversal and getting caught trading the other side of the market. We had everything prepped to understand that sweeping this low would just be tapping into liquidity and allowing fuel for a run higher. And that is exactly what happened. Now, another thing I want to cover on this topic is something that's a lot less advanced, but I haven't actually covered it yet in the bootcamp. I had some presumption of knowledge. If you're newer to trading and you've used this bootcamp as kind of the entryway to learning, then this class and this bit of the class is going to help you a lot, all right? So it is very important, in fact, completely crucial, that when we are looking at a candle, determining a break, or for anything really, we have to wait for that candle to close. So each candlestick is showing price action within a time frame of, say, let's say 1 hour, right? That means at the start of the hour, the market opened here, and at the end of the hour, the market will close somewhere and print the full candle. However, until the time scale or the time frame you're on has actually closed the candle, anything can happen, right? So you could be looking at this, we've broken above structure, and seeing this as a reversal. And you might start looking for opportunity to buy into this. So you might be looking at prepping your buys or placing your orders to take the market higher because you've seen the markets traded above this high. Therefore, this is bullish. But the thing is, because the candle hasn't yet closed, it could go up more. That would be good news. But it can also come back down and close beneath the high. And if this happens, then all we have is a wick. We just have a rejection, right? Which shows us that this market did not have intent to go higher. It had intent to trade towards where, as we've just been discussing, the fuel is for another downward move. And then after we hit that area with enough fuel to bring the market back down, the next likely thing, as per what we've just been through, is going to be continuation of lower price. So you have to wait for candlesticks to close in order to determine whether it's a sweep or a reversal. Because if we close as a candle body, then you've got good indication that this could be a bullish opportunity, okay? All other things considered. But if we close as a wick like this, or even shifting back bearish like this, well, then you're in a situation where everything looks completely different. And if you're in your earlier days of trading, you probably have been killed by this a few times. You get into trades up here, you think this is it, you buy in, maybe you buy in here or whatever, but then by the time the candle closes, it looks like this. And now you're sitting on a buy from this level, and it's not looking good for you because we're now trading all the way down here. So waiting for candle bodies to close, just the final and very simple tip to determine structure breaks versus sweep reversals, because if we close as a wick, we're showing rejections, not closures, okay? So closures above or below structural points, that's good, like this. Closures with wicks beneath the structural high or above the structural high. Closures beneath the valid structural point with only wicks above the level, then this is not good, not something we want to be treating as a reversal. This is a sweep, this is a reversal, okay? So that's pretty much everything for this class. Hopefully you found this valuable, as I'm sure you probably have. Head to the link in the description and watch the trading diagnosis class where I teach you everything that's keeping you back away from the charts, the things you probably haven't considered yet. It's only 15 minutes long, loads of value in there, so check that one out. And with that, I will see you in the next episode of the Bootcamp.